So I want you to imagine, just for a second, having $100 billion to invest.
Oh, wow. Yeah, just a casual 100 billion.
Right. Just close your eyes and picture that level of, infinite resource. I mean, most of us would think that having that much money literally solves every financial problem you could ever possibly encounter.
Oh, absolutely. It sounds like the dream.
But what if I told you that having $100 billion is actually your biggest disadvantage?
Wait, really? The biggest disadvantage?
Yeah, because you have so much cash that the simple everyday act of you buying an asset, it instantly ruins its price. You are literally too big for the market.
That's a fascinating way to look at it.
So today we're looking at what happens when the perfect, pristine math of investing collides head-on with the messy, friction-filled physics of the real world.
It really is the ultimate reality check, isn't it? I mean, we spend so much time in finance looking at these beautiful, elegant spreadsheets. You run a mean variance optimization, the algorithm calculates your expected returns, your covariances, and then it prints out this flawlessly balanced pie chart.
The dream portfolio.
Exactly. It tells you mathematically the absolute optimal path to wealth. But that spreadsheet assumes you are operating in a total vacuum. It assumes zero friction.
Yeah, it assumes you aren't paying taxes. It assumes you don't, have an emotional breakdown when the market drops.
Which everyone does.
Which everyone does. And it assumes you can seamlessly buy any asset on Earth, regardless of your size. But none of those things are actually true.
No, not at all.
So the mission for our deep dive today is to take a massive, really comprehensive look into Reading 5. It's called Asset Allocation with Real-World Constraints.
A very fitting title.
Right. We are basically leaving the theoretical classroom today. We are taking that beautiful architectural blueprint of a portfolio, and we are dragging it right through the mud of reality.
Which is exactly what this source material does. I mean, it doesn't treat real-world constraints as just, mere footnotes or afterthoughts. They are the main event.
Yeah, they change everything.
They do. If you don't adjust your strategic asset allocation for the physical size of your money, the ticking clock of your actual life, the tax code, and frankly, your own psychological flaws, your perfect model isn't just slightly off. It will completely fail you.
Okay, let's jump right in then. And I want to start with that $100 billion problem because it falls under what we can call the Goldilocks problem of asset size.
The spatial constraint.
Exactly. The most tangible physical constraint you face is the sheer amount of capital you are managing. Size completely dictates the rules of the game. Let's look at both extremes, starting with the plight of the small fund.
Well, when the text refers to a small fund, we really need to define that first.
Good point. What is small in this context?
We aren't necessarily just talking about a retail investor with a standard 401k. A small fund could be, a local university endowment with $50 million or a small family office.
$50 million does not sound small to me.
Right. In everyday life, it's huge. But in institutional finance, it's tiny. The primary constraint they hit immediately is a lack of infrastructure. They simply don't have the critical mass to operate like a giant institutional player, like, say, the Yale Endowment.
Because operating at that level is just wildly expensive, right? You can't just casually decide to allocate 20% of your portfolio to some complex, distressed debt strategy.
Or a private equity buyout fund, yeah. To do that safely, you need a massive governance structure. You need specialized in-house experts to perform the deep due diligence.
And those experts cost a lot of money.
Oh, totally.
Yeah.
You need expensive data feeds. You need a whole team of lawyers to review the partnership agreements. A $50 million fund cannot afford to pay a team of analysts millions of dollars a year in salary just to oversee a $10 million allocation.
The overhead would just eat all the returns.
Exactly. The fees would consume it all.
And even if they could somehow afford the staff, there are literal legal walls keeping them out, right? The source material points out that local legislation restricts certain asset classes strictly to investors with a massive defined levels of capital.
Yeah, the regulatory frameworks are very strict there.
Right. Like, if you don't have $100 million or $500 million to play with, the regulatory door is just locked. You aren't deemed a qualified purchaser.
Which creates a severe mathematical problem for their portfolio. It creates a lack of diversification.
How so?
Well, if regulatory walls and infrastructure costs shut you out of alternative assets like private credit, direct real estate, venture capital, your portfolio is artificially constrained. You are forced to hold much more concentrated risk in standard public equities and bonds.
More than the optimal math would actually suggest.
Exactly. You're blocked from the efficient frontier.
So what's the escape hatch for the small fund? Because the text gives a very specific solution here.
Pooling. That is the answer. If you are too small to get through the door on your own, you have to band together.
Like teaming up.
Right. Small funds where individual investors can pool their money through commingled investment accounts, like mutual funds, or specialized institutional pools. Or, in the case of wealthy but disparate relatives, they can create consolidated family asset pools.
Oh, I see. So by combining their capital into one entity, they suddenly cross those regulatory thresholds.
They achieve the scale.
Right. They get the scale necessary to hire the expensive managers, build the governance structure, and unlock those complex assets. They basically form a financial Voltron.
That's a really good way to picture it, actually. But let's flip the script, because this is where the source material gets really fascinating. You solve the small fund problem by getting bigger. Hmm. So logically, having infinite money should solve all your problems, right?
Right. The mega endowments, the sovereign wealth funds managing hundreds of billions. They have the lawyers, the data, the scale. They have access to literally everything.
They do. But their sheer size becomes a massive, heavy anchor. They are plagued by a completely different constraint.
Which is what?
Market capacity. Let's say you run the optimization math for a $300 billion sovereign wealth fund. The algorithm looks at the global landscape and says, to achieve the absolute best risk-adjusted return, you need to allocate 5% of your capital to this highly profitable, very specific niche of European distressed infrastructure debt.
Okay, let me just do the math on that. 5% of 300 billion, that is a $15 billion allocation.
Right. Now, what happens when you look out at the real world and you realize that the entire investable market for European distressed infrastructure debt is only $3 billion?
Oh, wow. Your mathematical model is telling you to buy 5 times more of the asset than actually exists on planet Earth.
Precisely. Massive funds can easily and completely accidentally exhaust the available asset pools of these highly lucrative alpha-generating strategies.
That is wild.
And even if the market is big enough to theoretically hold their money, their size ruins the trade through price impact.
Okay, walk me through the mechanics of that. How does their size actually ruin the trade?
It's sort of like trying to fill a small backyard swimming pool using a high-pressure industrial fire hose.
Okay, I'm picturing it.
The pool is the profitable microcap stock you want to buy, and the water is your massive capital. The moment you turn that fire hose on, you don't just gently fill the pool. The sheer, violent force of your capital completely blows the concrete out of the ground.
Oh, man.
In market terms, when a mega fund tries to deploy billions into a small, illiquid market, there just aren't enough sellers. To get their orders filled, they have to keep bidding the price higher and higher and higher.
Because everyone sees them coming.
Right. By the time they finish buying, their own massive demand has driven the asset's price up so much that they've completely destroyed the profit margin they were trying to capture in the first place.
I love that fire hose analogy. So the math says, buy this asset at $10 and it will grow to 12. But because you're buying so much of it, your very first order pushes the price to 11, then 11.50.
Exactly.
And by the time you're fully invested, your average purchase price is already $12. You just erased the return.
You erased it yourself. So what is the mega fund forced to do?
Yeah, what do they do?
They have to accept a structural compromise. Their strategic asset allocation will be heavily biased toward the most liquid, largest asset classes in the world: large-cap global equities, U.S. treasuries, major sovereign debt.
Because those are the only pools deep enough for their fire hose?
Exactly. They have to find their returns in macro movements because they're simply too big to participate in the micro niche opportunities.
That is wild. The ultimate constraint is that your own gravity warps the space around you.
Very well put.
Now, before we move on from the initial allocation phase, I noticed the text brings up ESG, environmental, social, and governance goals. I always assumed you just threw ESG ratings into the optimization algorithm alongside volatility and expected return and just let the math sort it out.
That is a very common assumption, but the source material clarifies that ethically acceptable assets are rarely integrated into the pure mathematical optimization of the main portfolio.
Wait, really? Why not?
Because ethics don't map cleanly to risk and return variances. You can't put a standard deviation on a moral stance.
I see.
Instead, the standard practice is to treat ESG as a hard physical constraint. The allocation is entirely carved out, set aside specifically, and invested only in acceptable assets. It functions as a distinct pool with a distinct mandate, rather than just another fluid variable in the algorithm.
Got it. It's a wall you build before you even start the math. Okay, so we've established that the physical space your money takes up, its massive scale or its tiny footprint, it bends the rules. But size is a spatial constraint. What about the chronological constraint? Let's talk about time and this sub-portfolio strategy.
Time is a massive factor,
When we think of a time horizon, we usually think of one big number, like I have 30 years until retirement.
which is the traditional institutional way to view a portfolio. You take an individual's entire life savings, you treat it as one giant, fungible pot of money, give them a questionnaire, and assign a single risk tolerance to the whole pot.
Right. Like you scored a 7 out of 10 on the risk quiz, therefore your entire life savings is allocated to 60% stocks and 40% bonds.
But the text argues that this is fundamentally flawed for individuals, because time isn't just a duration. Time is a series of evolving real-life milestones.
And to illustrate this, the source material gives us a fantastic, very tangible scenario, the Big Stone family. Let's break down what the Big Stones are doing because they are utilizing something called goals-based investing.
The big stones recognize that they don't have one single timeline. They have multiple overlapping timelines, and each one is attached to a highly specific, real-world liability.
So instead of one giant pot, they divide their financial life into 4 distinct goals and create a distinct subportfolio for each one.
Exactly. Let's walk through those buckets because this is where the real-world friction becomes visible.
Okay, goal 1 is funding their lifestyle. But they don't just say, we need money to live. They meticulously divide their lifestyle into 3 sub-tiers.
Which is crucial.
The first tier is the minimum or worst-case lifestyle. This is keeping the lights on, buying basic groceries, paying the property tax, just pure survival.
Right.
The second tier is the baseline lifestyle. This is maintaining their current comfortable standard of living. And the third tier is aspirational, taking luxury vacations, buying a boat, things they want but don't strictly need.
Notice how the required risk tolerance drastically changes based on the necessity of the tier. The minimum lifestyle tier is a non-negotiable liability. If the stock market crashes by 50%, the big stones still need to eat.
Yeah, you can't tell your stomach the market is down.
Right. Therefore, this portfolio receives a highly conservative allocation. The text specifies it as 100% bonds and cash. You simply cannot take equity market risk with survival money. And for the big stones, this represents 65% of their total initial portfolio.
Okay, so the foundation is rock solid. But for the maintain baseline tier, which represents 12% of the total portfolio, they assign a moderate risk, 60% equity, 40% bonds.
Yep.
And then for the aspirational tier, representing 8% of the total, it's aggressive, 100% equity. Because, I mean, think about it. If the market tanks, the consequence is just that they don't go to Paris that year. They don't buy the boat. The risk of loss is entirely acceptable.
Precisely. Now let's map out the remaining goals. Goal 2 is their daughter Alice's college education. That is a hard liability with a fixed, unmoving date.
Yeah, you can't tell a university to wait 3 years for the market to recover.
You definitely cannot. So it gets a conservative allocation, 100%, bonds and cash, representing 6% of the portfolio.
Okay. Goal 3 is a donation to Mark's mayoral campaign. This is highly aspirational, high risk, high reward. It gets an aggressive 100% equity allocation, making up 6%.
Right.
And finally, goal 4 is a philanthropic scholarship fund they want to start. Also aspirational, aggressive, 100% equity, making up the final 3%.
So if you were to aggregate all these little sub-portfolios together and look at the whole pie, the big stones have an overall portfolio that is 25% equity and 75% bonds.
Okay.
But the crucial point is that they didn't arrive at that 25-75 mix by taking a generic risk quiz. They built that allocation from the bottom up, meticulously matching the volatility of the asset class to the priority and timeline of the specific liability.
And here is where the concept absolutely clicked for me. The text asks us to do a 15-year time jump. What happens to all this math when 15 years of real life actually occurs?
Everything shifts organically. Think about the liabilities. 15 years later, Alice is 30. She has graduated.
The college goal is fully funded, paid out, and gone.
Mark either won or lost the mayoral race 15 years ago. That goal is gone.
And even more fundamentally, Mr. and Mrs. Big Stone are 15 years older. That means they have 15 fewer years of lifestyle consumption left to fund on this earth.
Exactly. The raw amount of capital required in that minimum lifestyle bond bucket is mathematically much smaller now.
Because the liabilities have been resolved?
Yes. The only thing left from their original secondary goals is that highly aspirational scholarship fund. So what happens to their aggregate asset allocation?
Without anyone having to sit down, run a new optimization model, or fundamentally rethink their core philosophy, the overall portfolio naturally and automatically shifts its equity to bond ratio.
Exactly. Because the conservative short-term liabilities have been paid off, the remaining capital is heavily weighted toward the longer-term aspirational goals. The portfolio evolves dynamically simply because the time horizons of the sub-portfolios resolve themselves in the real world.
Okay, but I have to play the role of the skeptical listener for a second.
Go for it.
Hold on. We are taking one big pot of money, money that is totally fungible, a dollar is a dollar, and we are arbitrarily breaking it into 6 different mental buckets based on labels we made up. Isn't that a cognitive bias?
I see where you're going.
Isn't that literally the definition of mental accounting, which behavioral economists are always telling us is a terrible, irrational thing to do?
That is an excellent observation, and the text specifically addresses this exact tension.
Yeah.
It is true that irrational mental accounting is a bias.
Right.
For example, if you treat a tax refund as free money and take it to the casino, but you treat your paycheck as serious money to pay the mortgage, that is an error in logic. The dollars are identical.
Oh.
But using goals-based investing as a deliberate, structured framework is different. It actually mitigates bad behavior.
Oh, I see. You're actually weaponizing the brain's natural bias to categorize things and using it to protect the investor from themselves. You're using the flaw as a feature.
Precisely. The human brain cannot process the abstract concept of standard deviation. If the stock market drops 20%, an investor with one giant pot of money panics. They look at their total balance, see a massive red number, feel like their actual survival is threatened, and they sell everything at the absolute bottom.
Because they just see one giant pool of their life savings shrinking.
Yes, that is the real-world friction that destroys theoretical returns. But the big stones don't do that.
Because when the market drops 20%, they look at their sub-portfolios. They see that their minimum lifestyle bucket, their survival money, is entirely in bonds and cash. It hasn't lost a dime.
The college bucket is safe.
The only buckets bleeding are the aspirational ones, the vacation fund, the scholarship fund. And because they know those goals have long time horizons, they don't panic sell. The deliberate use of mental buckets acts as an emotional circuit breaker.
Exactly. It aligns the risk in a way the human brain can tangibly process. It ensures the math actually survives the stress of reality.
Man, that's smart. Okay, so we've solved the problem of scale, and we've mapped out the timeline of a human life. But there's a silent partner in every one of those life events who is going to demand a cut.
Oh, yes.
Let's talk about the friction of the tax code. How do taxes physically alter the DNA of our asset allocation?
Well, the most obvious impact is that taxes reduce your total return. We all know that. It's painful but intuitive. But what is far less intuitive and what the source material spends significant time on is the volatility paradox.
The volatility paradox.
Taxes don't just reduce your return, they fundamentally reduce the risk, meaning they dampen the volatility of your portfolio.
Wait, slow down. That sounds completely backwards. How can paying taxes to the government make my portfolio mathematically less risky?
Think about the tax code as a partnership agreement. The government is effectively acting as your silent partner, and they share in both your gains and your losses.
Okay.
Let's use real numbers. Imagine you invest, and you make $100 in profit. If your capital gains tax rate is 20%, you don't keep $100. You only keep 80. The government took 20, the upside volatility was reduced.
Right. That's the painful part.
But conversely, what if the market tanks and you lose $100?
Okay.
In a taxable account, you can typically use that realized loss to offset other taxes you owe. This is tax loss harvesting, a fundamental mechanism of the tax code.
Oh, right.
Because you generated a $20 tax savings from that loss, your actual out-of-pocket loss is only $80. The government effectively absorbed $20 of your downside.
Oh, wow. Because the government is shearing off the top of the peaks, but also filling in the bottom of the valleys, the actual mathematical swings of your after-tax wealth are much smaller than the pre-tax swings on the screen. The standard deviation, the actual volatility, is physically lower.
Exactly. And understanding that volatility paradox leads to a massive, highly actionable insight regarding portfolio rebalancing. Because the after-tax risk levels are demonstrably lower, taxable investors can actually afford to have much wider rebalancing ranges than tax-exempt portfolios.
Hold on, I want to make sure I grasp the math here because the text gives us a specific formula for this. Deviation after tax multiplied by 1 minus the tax rate equals deviation pre-tax. Let's ground this. Let's
Yeah.
invent a guy named Bob.
Okay, Bob.
Bob has $100,000 and a target allocation of 50% stocks. If he was a tax-exempt entity, like an endowment, he might have a strict rule. If my stocks drift 10% away from the target, I must rebalance. His pre-tax deviation limit is 10%.
Right. If his stocks grow and hit 60% of his portfolio, a 10% absolute deviation, the tax-exempt endowment would instantly sell stocks and buy bonds to bring it back to 50%.
But Bob is not an endowment. Bob is a human being with a 20% tax rate. Because his volatility is mathematically dampened by the tax code, he can let his portfolio wander much further before his true after-tax risk profile matches the endowment's risk profile.
Yes, let's plug it into the formula.
Okay, so we want to find Bob's allowable after-tax deviation. What number multiplied by 1 minus his 20% tax rate, so multiplied by 0.80 equals that strict 10% pre-tax limit?
The answer is 12.5%. If you take a 12.5% after-tax deviation and multiply it by 0.80, you arrive back at a 10% pre-tax deviation.
So Bob doesn't need to rebalance when his stocks drift by 10%. He can let them run until they drift 12.5% off target. Why is that such a big deal, though? Why does letting it run actually matter?
Because of the rebalancing trap. If Bob ignores the tax math and he forces his taxable portfolio to rebalance tightly and frequently at that 10% band, what is he physically doing?
Yeah.
He is constantly selling stocks that have gone up in value.
And every time he clicks sell on a stock that went up, he triggers a realized capital gain. He generates a tax bill.
Exactly. By rebalancing too tightly, he is forcing his portfolio to unnecessarily bleed cash to the government. He's interrupting the compound growth of his capital. Frequent rebalancing in a taxable account creates a massive compounding drag on wealth.
Wow.
That's why the text emphasizes that adjusting for taxes after making your allocations leads to suboptimal results. The tax code isn't a footnote you calculate at the end of the year. It is an active mathematical participant in the portfolio's correlation and volatility metrics on day one.
I want to try an analogy here to see if I've got it. Taxes act like a heavy-duty shock absorber on your portfolio suspension system.
I like this.
They create drag, which slows down how fast you can accelerate on the highway. That's the tax on your gains. But they also absorb a massive amount of the kinetic energy when you hit a deep pothole. That's the government eating part of your loss.
Perfect.
Because you have that heavy shock absorber installed, your vehicle can comfortably handle a much bumpier road, meaning you can let your assets wander a bit further out of their target lane before you have to spend the money, the taxes, to yank the steering wheel back and realign them.
That is a phenomenal way to visualize it. The shock absorber fundamentally alters the mechanics of the vehicle. And once you understand how that shock absorber works, it allows you to play a highly lucrative game called asset location. Not allocation, but location. Where do you physically park the assets you own?
Right, because an investor like Bob likely has multiple buckets with different tax rules. He has a fully taxable brokerage account where he feels the full brunt of the IRS. But he also has tax-advantaged accounts, like a 401k or a Roth IRA, which act like tax-free force fields.
Yes, force fields.
The source text gives us very clear rules on which assets go into which buckets.
The location rules are driven entirely by the inherent tax efficiency of the asset itself. Think about assets that generate high levels of ordinary income, like taxable corporate bonds that pay out high interest every month, or actively managed hedge funds that are constantly trading and generating short-term capital gains.
Those assets are terribly tax inefficient. If you put them in a taxable brokerage account, the IRS is going to bleed them dry every single year. The compound growth will just be destroyed.
Exactly. Therefore, those highly inefficient assets belong safely inside the tax-advantaged accounts. You use the 401k or IRA as a shield to protect the assets that need the most protection.
And conversely, what goes into the taxable unprotected brokerage account?
Assets that are already highly tax efficient on their own. In many jurisdictions, buy and hold public equities are incredibly tax efficient. Long-term capital gains and qualified dividends often receive preferential lower tax rates.
Right, they get a discount.
Plus, if you just buy a broad index fund and hold it for 20 years, you don't generate any capital gains taxes until you finally sell decades later. The asset shields itself through deferred realization.
I see. You don't want to waste the protective force field of your limited IRA space on an equity index fund that is already highly tax efficient. You save the shield for the corporate bonds.
You're optimizing the space.
Asset location is a jigsaw puzzle where you maximize your total after-tax return by pairing the least efficient assets with the most protective account structures.
Precisely. It is one of the only free lunches in finance. By simply locating the assets correctly, you increase your long-term wealth without taking on a single ounce of additional market risk.
Okay, let's take a breath and summarize the architecture we've built so far.
We've covered a lot.
We really have. We've organized the money by its physical size to avoid breaking the market. We've mapped it across the timelines and priorities of family goals to prevent panic selling, and we've optimized the location and the rebalancing ranges to mitigate the friction of the tax code. We have successfully built a robust, real-world strategic asset allocation, or SAA.
Yes, the SAA.
But here is my question. Is it set in stone? Do we just print the spreadsheet, lock it in a drawer, and walk away for 40 years? The answer, of course, is no. Life happens. Economies crash. And that brings us to Section 4, shifting the strategy.
The SAA is your baseline, your true north. But you have to be able to navigate the weather. We are talking about the transition from static strategic asset allocation to dynamic tactical asset allocation and adjusting for the macro business cycle.
Let's start with how the sheer force of the business cycle can fundamentally force an institution to abandon its optimal math. The source text gives a very vivid, high-stakes example of the airline industry.
Yeah, let's unpack this airline example. Put yourself in the shoes of the chief investment officer managing the pension fund for a major global airline.
Okay, I'm the CIO.
The economy enters a severe recession. The business cycle is in a vicious downturn. What happens to the airline? Vacations are canceled, corporate travel budgets are slashed to zero, and low-cost competitors start a ruthless price war just to get bodies in seats. The airline's core revenue stream becomes incredibly volatile and uncertain.
Now, zoom out and look at what is happening to the pension fund at that exact same moment. In a severe economic downturn, global equity markets are likely crashing. The assets inside the pension fund are shrinking rapidly.
Right.
Under pension accounting rules, this means the plan is suddenly underfunded. And when a pension is underfunded, it legally triggers a requirement for the corporate sponsor, the airline, to pump massive amounts of cash into the pension to make up the shortfall.
But wait, that's the trap. The airline has no cash. Their core business revenues just dried up because nobody is flying. They're being hit by a perfect catastrophic storm. The pension liability is demanding emergency cash exactly at the moment. The core business is bleeding cash. It's an existential threat to the company.
Which is exactly why the business cycle forces a profound shift in the strategic asset allocation. When cyclical companies like airlines or auto manufacturers face uncertain revenues during a downturn, their pension funds cannot afford to act like a standard endowment trying to maximize returns. They must intentionally de-risk, they have to sell their volatile equities and buy highly stable, low-yielding bonds.
Even if the long-term math says equities are a better investment, they have to abandon the optimal return to ensure survival.
Exactly. They de-risk to deliberately smooth out the volatility of the pension assets, ensuring that they won't trigger a massive required cash contribution when the parent company is fighting for its life. The macro business cycle literally dictates the micro-risk tolerance of the fund. The goal shifts from maximize wealth to survive the cycle.
That makes perfect sense.
Yeah.
You can't worry about compounding at 8% if the company goes bankrupt tomorrow.
Exactly. Now, the text also details how strategies must shift without a dramatic economic crisis, but simply through the relentless passage of time. They call these predetermined glide paths.
Target date mutual funds are the ubiquitous example of a glide path. You see them in almost every 401k plan, a fund labeled Retirement 2050 or Retirement 2060.
Yeah, I have one of those.
These are brilliant because they recognize that human beings are terrible at proactively managing their own shifting risk tolerance. The fund operates on an autopilot glide path. When the target date is far away, the fund is heavily concentrated in high-risk, high-reward equities. But as the target year approaches, it automatically slowly sells off those equities and buys conservative investments, specifically nominal bonds and inflation-protected securities.
But why? I know that's what they do, but let's dig into the why. What is the actual financial mechanism that requires a 65-year-old to hold bonds when a 25-year-old holds stocks?
It comes down to the relationship between human capital and financial capital. When you are 25 years old, your financial portfolio is probably tiny. Your true wealth is your human capital, the mathematical present value of the 40 years of wages you are about to earn. You are effectively walking around as a multi-million-dollar high-yield bond.
Wow, I love that. A walking bond.
Because your paycheck provides extreme stability, your tiny financial portfolio can afford to take massive equity risks. If the market crashes when you are 25, who cares? You have 4 decades of paychecks to cover your lifestyle.
Uh, but as time passes, every time you collect a paycheck, you are converting your human capital into financial capital. By the time you are 65 and retiring, your human capital has depleted to zero. You have no more paychecks coming.
Precisely. At 65, your financial capital must completely take over the role of generating your income. It has to become your paycheck. Therefore, the portfolio itself must transform from a volatile growth engine, equities, into a stable income generator, bonds. The glide path simply automates the conversion of depleted human capital into secure financial capital.
That is a brilliant way to frame it. The portfolio has to become the bond that you used to be. Okay, so we have SAA shifts based on existential business crises and automated shifts based on aging. But there is a third way the strategy shifts, and this one requires active, aggressive management. Tactical asset allocation, or TAA.
TAA is the intentional, short-term alteration of the SAA to enhance returns by exploiting immediate market inefficiencies. Let's say your strategic true north is 60% equities and 40% bonds. TAA might dictate, based on current data, for the next 6 months, we are going to tilt the portfolio to 65% equities and 35% bonds because we see a specific opportunity.
But what are they actually looking at to make that decision? The text breaks down TAA indicators into two main philosophical camps: value and momentum. Let's dig into value first. The core idea here is seeking excess return because something is mathematically mispriced.
Exactly. Buying what is cheap and selling what is expensive. For equities, the source material specifically highlights Robert Shiller's earnings yield, often called the KPE ratio, or Shiller's E over P. This is a vital metric. It is not just a standard price-to-earnings ratio that you look up on Yahoo Finance.
Right, because a standard PE ratio just looks at the last 12 months of earnings, which can be incredibly deceiving. If we just had a massive recession, corporate earnings last year were probably terrible. That makes the PE ratio look astronomically high, signaling that stocks are expensive. But they might actually be cheap, right?
Exactly. The standard PE ratio is too sensitive to the short-term noise of the business cycle. Shiller's metric solves this by using a 10-year inflation-adjusted average of earnings. By looking at a full decade of data, it smooths out the peaks of economic booms and the valleys of recessions. It gives the investor a true structural picture of the stock market's baseline earning power. If Shiller's E over P is significantly higher than its historical average, the market is broadly cheap, and TAA dictates you overweight equities.
Okay, so that's the value indicator for stocks. But what about commodities? The text brings up two massive, slightly intimidating concepts here: backwardation and contango. Let's spend some real time on this, because this isn't just about the price of a barrel of oil. It's about the physical mechanics of the futures market.
This is critical. When large funds allocate to commodities, they don't buy physical barrels of crude oil and store them in a warehouse in New Jersey. They buy futures contracts, paper agreements to buy oil at a specific price on a specific date in the future. And the relationship between the current price of physical oil today, the spot price, and the price of that future contract determines everything.
Let's start with backwardation. The text says backwardation provides a positive roll yield, making it a strong value signal to buy commodities. Walk me through the actual physical transaction.
Imagine the current physical price of oil today, the spot price, is $100 a barrel. But the futures market is predicting that oil will be cheaper in 6 months. So a futures contract expiring 6 months from now is currently trading at $90. The curve is sloping downward. This state is called backwardation.
So as an investor, I step in and buy that $90 contract. I lock in the right to buy oil in 6 months for $90. But I never actually want the physical oil. I'm just an investor.
Yeah.
What happens as those 6 months pass?
As time passes, the expiration date gets closer.
Yeah.
And as the contract approaches its final day, the paper price of the future must mathematically converge with the physical reality of the spot price. If the spot price just stays flat at $100, your $90 contract naturally rolls up the curve toward $100.
Oh, I bought it at $90, and just by sitting on my hands and letting time pass, the contract's value creeps up to $100 to meet reality. I made $10 a barrel, and the actual price of oil didn't even go up.
Precisely. That $10 profit is called a positive roll yield. You are generating return simply from the structural shape of the market curve and the passage of time. Therefore, when a commodity market is in backwardation, it is a massive flashing green light for TAA to overweight that commodity because the curve itself is paying you a dividend.
But then we have contango, the evil twin. Contango is a signal to underweight commodities because it bleeds your returns. How does that work?
Contango is the exact opposite scenario. The physical spot price of oil is $100, but the market is nervous about a future shortage, or storage costs are extremely high, so the futures contract for 6 months from now is trading at $110. The curve slopes upward. You buy the contract at $110.
And as 6 months pass, assuming the spot price stays flat at $100, my expensive $110 paper contract has to slowly roll down to meet the $100 reality at expiration.
Yes. You lose $10 a barrel purely from the passage of time. You suffer a negative roll yield. The structure of the market is actively bleeding cash out of your account every single day. Even if the price of oil goes up a few bucks, you might still lose money because the contango drag is so severe. So contango is a hard signal to underweight.
That is fascinating. You aren't betting on the commodity, you are betting on the shape of the curve. Okay, to round out the value indicators, the text mentions currency and fixed income.
For currency, TAA looks at short-term interest rate differentials. If the central bank in country A is paying 5% interest and country B is paying 1%, global capital will logically flow like water toward the higher yield, supporting country A's currency. And for fixed income, TAA analyzes yield spreads. They look at the gap between the interest rate on risky corporate bonds and safe government bonds. If that spread is historically wide, say corporate bonds are paying 6% more than government bonds, when normally they only pay 2% more, it indicates that corporate bonds are mispriced, quote-unquote cheap, and offer a strong value opportunity.
So those are all value indicators, buying things because a mathematical metric says they are historically cheap. But the other major camp in TAA is momentum. This is a completely different philosophy. This assumes that trends, once established, tend to persist due to human psychology and capital flows. What are the indicators here?
The source material lists two primary rules-based momentum signals. First is simply the 12-month trend indicator. You look at the asset's performance over the trailing year. If an asset class, say emerging market equities, has been consistently going up for 12 months, momentum theory dictates that the probability is higher that it will continue going up in the near term. You deliberately overweight the winners.
And the second indicator is moving average crossovers. This is classic quantitative technical emphasis.
Right. You calculate a short-term moving average of the price, let's say the average price over the last 50 days. But you calculate a long-term average, like the last 200 days. The signal triggers when the two lines cross. If the 50-day average crosses above the 200-day average, it proves that recent momentum is accelerating faster than historical momentum. It is a mathematical buy signal. If the short line crosses below the long line, the trend is breaking down, signaling an underweight.
Okay, I have to stop you here. I have to push back. We spent the first half of this deep dive meticulously calculating the perfect strategic asset allocation based on size, the timing of family liabilities, and complex tax shock absorbers. If the SAA is our true north, isn't TAA just a fancy academic acronym for market timing? Aren't we just guessing when to jump in and out of the market based on squiggly lines on a chart? Every financial advisor on earth tells you that market timing is a fool's errand.
It is a vital distinction, and one the source material is very careful to draw, because you are right. Unstructured market timing is disastrous. But TAA is strictly bound by governance. It is not reckless market timing. It is governed, systematic deviation.
Governed deviation. Explain the difference.
When you build an institutional portfolio, you write an investment policy statement, the IPS. The IPS explicitly permits and severely caps the amount of tactical deviation allowed. It might say, you are allowed to drift a maximum of 3% from the equity target, and you can only do it if 3 specific, predetermined, quantifiable indicators trigger simultaneously. You aren't guessing. You are systematically applying heavily researched empirical metrics, like the physical contango curve or Shiller's robust decade-long E over P ratio, to make tiny, measured tilts. You shift from 60% equity to 62%. You don't panic, dump everything, and go to 0% cash. TA is driven by hard, pre-approved data, not by a portfolio manager's gut feeling while watching the news on a Tuesday morning.
The guardrails are bolted to the floor before the manager is even allowed to touch the steering wheel. That distinction between gut feeling and governed deviation is massive, and honestly, it provides the perfect, seamless transition to our final section, because gut feelings are the enemy. Let's move to section 5, the final boss, human behavior.
This is where it all comes together.
Yeah.
We have all the elegant math, We have the tax rules, the asset size constraints, the goals-based buckets, the quantifiable TAA indicators. But the final, most unpredictable, messy constraint in asset allocation is the biological computer actually running the spreadsheet, the human brain.
The human brain is an absolute disaster when it comes to statistics and probability. We are hardwired with cognitive and emotional biases that evolved to help us survive in the jungle, but those exact same instincts actively sabotage optimal asset allocation in modern markets. The text spends significant time detailing these specific biases, and, crucially, it prescribes physical, structural mitigations for each one. Let's walk through the gauntlet. Bias number one, loss aversion.
Loss aversion is the proven psychological reality that human beings feel the acute pain of a loss roughly twice as intensely as they feel the joy of an equivalent gain. Losing $100,000 from your portfolio feels like a physical injury. Making $100,000 just feels like a good day. This asymmetrical pain leads investors to make terrible decisions, like holding on to losing stocks forever because they refuse to realize the loss, or panicking and selling everything at the bottom of a crash just to make the pain stop.
How does the text say we mitigate this? You can't just tell someone, stop feeling pain.
No, you can't. Which is why the mitigation we discussed in Section 2 is so powerful. Goals-based investing. You mitigate the irrational panic of loss aversion by pre-framing the pain. By bucketing the funds, you isolate the emotional damage. When the market drops 30%, the investor doesn't feel a 30% loss to their survival. They see that their conservative minimum lifestyle bucket is fully intact. Only the aspirational bucket took a hit. You use the structure of the subportfolios to soothe the biological panic response.
Okay, next up, we have a lethal combination. Illusion of control and representative, or recency bias. Illusion of control is exactly what it sounds like. The ego-driven belief that you can control or accurately predict complex, chaotic market events. I just know this tech stock is going to pop after earnings.
And recency bias is the human tendency to assume that whatever just happened in the recent past will keep happening forever into the future. If tech stocks have rallied for 3 years straight, the brain automatically assumes they will rally for the next 10 years. It leads to incredibly dangerous, undiversified trend following at the exact top of the market.
So how do you stop an arrogant portfolio manager who suffers from illusion of control and is chasing a recent trend?
The mitigation for this isn't psychological. It is purely structural. The text prescribes mitigating these biases through a strong, unwavering corporate governance structure. If a SAR manager believes they can predict the market and wants to double their allocation to tech stocks, the governance process acts as a physical barrier. The strict risk limits in the IPS, the mandatory peer review process, the investment committee veto, this structure forces the manager to prove their thesis with empirical data, or it physically stops them from executing the trade. Governance is the circuit breaker for human ego.
I love that. Governance is the circuit breaker for ego.
Bias number 3, availability, familiarity, and home bias. These are all close cousins. Availability bias is giving way too much weight to information that is easily recalled, like a recent terrifying news headline you read this morning, while ignoring decades of boring statistical data. Familiarity bias is investing in like a tech worker putting all their retirement money into their own company's stock, or a local real estate project simply because it feels comfortable and nearby. And home bias is the systemic global tendency of investors to massively overweight their own home country's assets while ignoring the rest of the world. A U.S. investor might have 90% of their portfolio in U.S. stocks, completely ignoring the fact that the U.S. only makes up roughly half of the global equity market. It results in a massive, uncompensated concentration of geographic risk.
And the text offers a very specific mathematical anchor to mitigate these comfort biases.
Yes, to mitigate familiarity and home bias, the source material dictates that you must always, unconditionally, start the asset allocation process from the CAPM Global Market Portfolio as your neutral baseline zero.
Okay, let's pause here. The capital asset pricing model global market portfolio, what exactly is that? Are we talking about literally every stock and bond on Earth? How do you even measure that, and why does it cure home bias?
The global market portfolio is the theoretical aggregate of all investable risky assets in the entire world. Every stock in every country, every corporate bond, every piece of investable real estate, weighted precisely by their actual total market capitalization. It is the ultimate expression of objective reality. It represents how the aggregate wealth of the entire human race has chosen to allocate capital.
Okay, so it's the ultimate baseline. But how does starting there prevent me from buying too much U.S. tech stock?
Because if you start with a global market portfolio, and it says U.S. tech stocks should only be 15% of your portfolio based on global weightings, but you want them to be 40% because they feel familiar, the governance structure forces you to mathematically justify that massive deviation. You have to write a thesis explaining why you, sitting at your desk, are demonstrably smarter than the aggregate pricing mechanism of the entire planet. It forces you to acknowledge that your comfort is actually an aggressive, active bet against global reality. That heavy burden of proof usually stops the bias in its tracks.
You have to prove why you disagree with the planet. That is brilliant. Finally, we have framing bias. This is a subtle one. This is when the decision you make is altered purely by how the information is presented to you rather than the data itself. If I tell you this distressed debt asset has a 10% chance of total catastrophic failure, you will probably run away in terror. But if I say this asset has a 90% historical success rate of generating massive yields, you might buy it immediately. It's the exact same math, but the frame completely changes your emotional reaction.
The mitigation here is rigorous, boring standardization. You mitigate framing bias by ensuring that the starting point of any investment decision includes the full range of relevant information presented in a strictly neutral, standardized institutional format. You don't let the analyst who is pitching the stock choose the fonts, the colors, or the graphs on their PowerPoint. They have to use the mandated standard template that highlights the downside risks just as prominently in the exact same format as the upside potential. You remove the marketing from the map.
So, synthesizing all of this behavioral psychology, the expert analysis here is clear and a bit humbling. Recognizing that you have a bias isn't enough. You can't just read a book on cognitive psychology, nod your head, and say, okay, I'm cured. I am aware of loss aversion, so I won't be loss averse anymore.
No, you won't be cured. Because under the severe emotional stress of a market crash, your intellectual awareness evaporates, and human nature will always revert to its primal biases. The text specifically champions strong governance as the ultimate necessary shield.
What does that actually look like in practice during a crisis?
Governance means establishing clear short-term and long-term objectives before the crisis hits, when heads are cool. It means strictly assigned responsibilities, having an ironclad rule about who is actually authorized to pull the trigger on a liquidation trade and who cannot. And it means establishing a framework for periodic, dispassionate internal audits to ensure the rules of the IPS are actually being followed, regardless of how the manager feels about the market that day.
Let me bring back an analogy here to tie all this together. These cognitive biases, loss aversion, home bias, recency bias, they are like gravity. You can't just wake up in the morning, look in the mirror, and decide you aren't going to experience gravity today. It is a fundamental, inescapable physical law of your environment.
Exactly.
So how do we fly? The governance process, the CAPM global baseline, the strict rules of asset location, the goals-based buckets, those aren't just neat psychological tricks. They are the aerospace engineering. They are the thrust, the lift, and the aerodynamics that keep the portfolio from crashing back to Earth. You don't defeat gravity by ignoring it or wishing it away. You build a plane that is mathematically engineered to overcome it.
That is the absolute perfect encapsulation of Reading 5. The pristine math of strategic asset allocation, the mean variance optimization, the efficient frontiers, that is the theoretical physics of flight. But the governance structure, the tax management, the size adjustments, the behavioral guardrails, that's the heavy physical engineering that actually gets the plane off the ground and keeps it flying in a real world filled with gravity, friction, and crosswinds.
What a massive, comprehensive journey we've been on today. We started with the sheer, undeniable physics of asset size, how being too small shuts you out of the room entirely, and how being too big turns your capital into a fire hose that destroys the market you're trying to invest in. We traveled through the timelines of the Big Stone family, learning how to actually weaponize our own mental accounting through goals-based investing to protect us from panic selling during a crash.
We calculated the deep friction of taxes, realizing that the government, by acting as a shock absorber for our losses, fundamentally changes the math of volatility, allowing us to widen our rebalancing ranges and stop bleeding cash.
We explored the strategic, necessary shifts of tactical asset allocation, using hard, governed data like the contango curve and Shiller's inflation-adjusted E over P to make calculated deviations rather than relying on gut-feeling market timing. And finally, we confronted the final boss. The hardwired psychology of the investor and how strict, boring, unwavering governance is the only true shield against our own destructive biases.
It is a complete view of why finance is not, and can never be, just an exercise in abstract math on a pristine spreadsheet. It is a highly practical, deeply human endeavor that requires navigating relentless friction.
So I want to leave you, the listener, with a final provocative thought to mull over. Take a hard, honest look at your own portfolio or the portfolios you manage for others right now. Is it built for the theoretical vacuum of perfect math, assuming no friction, no taxes, and perfect robotic rationality? Or is it engineered for the messy, unpredictable real world? And more importantly, think about those cognitive biases we just walked through. Which one is currently quietly draining your returns right now, simply because you haven't put the right governance bumpers in place to stop yourself from making a very predictable human mistake?
That is the multi-million-dollar question. Until you build the guardrails, you are just waiting for gravity to take over.
Thank you for joining us on this extensive deep dive. It's been an absolute beast of a topic, but a vital one. Because remember, as we've learned today, true mastery of asset allocation isn't just knowing how to calculate the numbers on a blueprint. It's knowing how to engineer those numbers to survive the mud, the taxes, and the friction of reality. Keep building your aerospace engineering, and we will see you on the next deep dive.